Then in part C, assuming that 1,750 executive chairs and 5,500 classic chairs are actually produced and the actual fixed manufacturing overhead is 1.95 million rand, prepare the journal entries for fixed manufacturing overheads. All right, journal entries, because everybody always loves journal entries, especially in management accounting. And this is for 8 marks, guys. All right, so let's have a look at these journal entries. Now remember, firstly, before you actually go into the journal entries, when it comes to allocating fixed manufacturing overheads to products, I've given you 4 steps that you need to work through. So we are going to go through those 4 steps. Once we've calculated everything in those 4 steps, we will then prepare the journal entries. And it will be much easier to prepare those journal entries once we've actually performed all of the calculations up front. Then, something else that's also very important here, guys, is you have not been told to ignore narrations. So when you are preparing these journal entries, you must include narrations. The only time you exclude narrations is if you are specifically told to exclude them. Okay, so let's have a look at this calculation. Now, the 4 steps that we work through when it comes to allocating fixed manufacturing overheads to products is first, in step 1, we calculate the allocation rate. Now, don't duplicate work, guys. In part A of the required, we did already calculate the allocation rate. Go back to our calculation in part A. We've calculated the allocation rate per unit for each product. And remember, if we just go to our calculations over here, there's the allocation rate calculation. You never want the allocation rate per machine hour. If you have the allocation rate per machine hour, you always need to convert it into an allocation rate per unit. And we did that. We multiplied by the number of machine hours required for each unit, and we calculated the allocation rate per unit. So please note, guys, we always want the allocation rate per unit. So let's just carry that forward. So the allocation rate per unit. That's always step 1. Then in step 2, we calculate the absorbed cost. And remember, we calculate the absorbed cost by taking the allocation rate and multiplying by actual production. So we have the allocation rate per unit from step 1. You can just bring that down. And we need to multiply that by actual production. And we were not given actual production in the scenario. However, if you go back to the required, you are told to assume that they actually produced 1,750 executive chairs and 5,500 classic chairs. So using that information, we can calculate the absorbed overhead. Then in step 3, we calculate the expenditure variance. And remember, we calculate the expenditure variance by taking the actual cost and deducting the budgeted cost. All right, so once again, we were not given the actual fixed manufacturing overhead in the scenario, but if you go back to the required, you were told to assume that the actual fixed manufacturing overhead is 1.95 million rand. We calculated the budgeted fixed manufacturing overhead in part A of the required. So if we go back to those calculations, here is the budgeted fixed manufacturing overhead including depreciation. It's 2,072,000. Remember guys, we want all of the fixed manufacturing costs, so we don't want to exclude depreciation. I gave you the information excluding depreciation to make it a little bit more difficult for you, so that you knew you had to add depreciation to this amount over here excluding depreciation. But we want all of the fixed manufacturing overhead costs, not just the cost excluding depreciation. We want the total fixed manufacturing overhead cost. So you must include the total over there. So it's 2,072,000. All right, and let's just clearly show that this comes from part A of the required. Let's do the same thing above as well, because we didn't perform this calculation over here, because all of this over here also comes from part A. All right, so we can then calculate the expenditure variance. And we need to say whether this variance is favorable or unfavorable. So you can see the actual cost is less than the budgeted cost, so this is going to be a favorable variance. Then lastly, we need to calculate the volume variance. And we calculate the volume variance by taking the budgeted overhead and deducting the absorbed overhead. So we have all of these amounts now. The budgeted overhead comes from above. There's our budgeted cost from part A of the required. The absorbed cost we calculated in step 2, so you can just bring that down. So that gives us a variance of 203,500. Then once again, we need to say whether this variance is favorable or unfavorable. But we don't look at the rand amounts because this is a volume variance. We need to look at the volume to determine whether the variance is favorable or unfavorable. So we need to compare the budgeted production volume to the actual production volume. So firstly, the budgeted production volume, if you go back to the information provided in the scenario, we were not given production volumes. However, we were given sales volumes, and we know that they don't hold any inventory of finished products. So we said production is equal to sales, which means if they wanted to sell 1,800 executive chairs, they would need to produce 1,800 executive chairs. And the same logic applies to the classic chairs. If they want to sell 5,400 chairs, they need to produce 5,400 chairs. So that's what they expect to sell, or what they budget to sell. So that's obviously also their budgeted production. And we were given the actual production volume in the required, 1,750 executive chairs and 5,500 classic chairs. So we can now see that this volume variance which we calculated is going to be favorable. And the reason why it's favorable is because they actually produced more than what they budgeted to produce. They actually produced 50 units more. So if they produced more, we have a favorable volume variance. And now that we've performed all of those calculations, we can prepare the journal entries. All right, so the first journal entry is to record the actual fixed overhead for the year. So we debit the fixed overhead control account, and we credit either accounts payable or bank, depending on whether this is cash or credit. And remember to include the journal narration. So we are recording the actual fixed overhead for the year. All right. So what is the actual fixed overhead? It's 1,950,000 rand. All right, and this has been taken to a control account. And remember, guys, the logic behind a control account is after we've processed all of our journal entries, it needs to balance to 0. So we've taken it to a control account, and now we're going to process the journal entries so that the control account comes back to 0. So in the second journal entry, we are now going to allocate the fixed overhead to inventory, because remember, the company uses absorption costing, so fixed overheads are included in the value of inventory. And at the same time, we are going to account for the volume variance. So we debit work in process, and we credit the fixed overhead control accounts. So we are taking this out of the fixed overhead control account, and we are taking it to work in process. Remember, work in process is a category of inventory. Inventory is made up of raw materials, work in process, and finished goods. So what we are doing is, because the company uses absorption costing, we are allowed to include these fixed overheads in the value of inventory. So we take it out of the control account, we credit the control account, and we take it to inventory, to work in process more specifically. Now, remember, guys, it's always important. What do we take to work in process? We always take the absorbed overhead to work in process. So what is the absorbed overhead? We calculated that above as well in step 2, but I'm just going to take it from here. The absorbed overhead is 2,275,500. So it's always the absorbed cost that goes to work in process. But it's not the absorbed cost that we take out of the control account. We take the budgeted cost out of the control account. And the budgeted cost is 2,072,000. So obviously you can see this journal entry doesn't balance, and the balancing figure is going to be your volume variance. And our volume variance is favorable. So if it's favorable, it means it's a credit to profit and loss. It's going to increase profit. So we are going to credit profit and loss with our volume variance. And you'll see this journal entry will then balance. And don't forget the journal narration. We are allocating fixed overheads to inventory. and we are accounting for the volume variance. Then we have one more journal entry, because remember I said to you the fixed overhead control account needs to balance to zero. It's a control account, and at this point in time it does not yet balance to zero. So we are going to force it to balance to zero. So you can see here we have a debit of 1,950,000. Over here we have a credit of 2,072,000. So to force this to balance to zero, we need to debit the fixed overhead control account, and we want it to balance to zero, so we are going to debit the fixed overhead control account with 122,000 Rand. And you'll see this account then balances to zero. You can perform the check. And the other side of the journal entry over here is going to be the expenditure variance, which is taken to profit and loss. And it makes sense that we are crediting profit and loss with the expenditure variance because the expenditure variance is favorable. So it's a credit to profit or loss. It's going to increase your profit. All right, and you'll also see the amount ties in. We calculated that the expenditure variance is 122,000 Rand. So you can see it all ties in perfectly. All right, and don't forget the journal narration. We are accounting for the expenditure variance. All right, guys, so that then answers part C of the required.